In January 2022, the State Bank of Pakistan took a major step towards reshaping the country's banking landscape. Inside a boardroom, the SBP governor and senior officials gathered to decide 5 of 20 applicants would receive Pakistan's first ever digital banking licenses. The applicants included powerful commercial banks, international fintechs, electronic money institutions, and existing microfinance players. But the SBP wasn't looking for the biggest names. It was looking for something different. The goal was to find players who could fast-track financial inclusion, automate banking operations, and redefine customer experience. Early in the discussion, the SBP ruled out commercial banks. Why? Because those banks already had the license to go digital. And despite building large teams and expensive tech infrastructure, they had failed to deliver a truly end-to-end digital experience. By the end of the day-long meeting, 5 names emerged. The first was Mashreq Bank, a UAE-based digital banking leader with deep experience and strong financial backing, and crucially, the appetite to absorb Pakistan's sovereign risk. The second was easypaisa, a household name in Pakistan's fintech space, despite losing over $200 million in the past 4 years. What gave them the edge? The backing of shareholders like Telenor and ANT Financial, and a commitment to bring global tech to local users. Next was Rakami Islamic Digital Bank, a consortium led by Planet N, Pakistan's Kuwait investment company, and Enertech, fully owned by the Kuwait Investment Authority. Then came 2 high-risk, high-potential bets. KT Bank, powered by Nigerian fintech Kuda and backed by Pakistan's Fatma Group and City School, and Hugo Bank, supported by Muller & Phipps, Getz Bros, and Atlas Consolidated. These 5 were issued in-principle approvals to begin building Pakistan's first true digital-only banks. So where are they now? easypaisa has received a full commercial license. Mashreq is in its pilot phase, Rakami and Hugo are awaiting pilot approval, and KT Bank has yet to apply. Digital banks could change the game, making financial services accessible, personalized, and affordable. But there are real challenges ahead. Beyond cybersecurity and liquidity risks, the biggest hurdle may be financial patience. Traditional banks in Pakistan make profits not through lending or innovation, but by parking cheap customer deposits in government bonds. Digital banks don't have that luxury. Instead, they must build products with customer trust and scale, all before turning a profit. And that profit won't come quickly. On average, digital banks become profitable in 5 to 7 years if credit-led, and after 10 years if they rely only on transactions and savings products. Worse still, most digital banks in Pakistan aren't yet credit-led, largely due to the lack of reliable data. That limits revenue options and makes them a long-term play, rather than a short-term win. To make matters tougher, the SBP has barred changes in ownership until these banks become profitable. That means investors are in it for the long haul, likely burning over $50 million each before seeing returns. Still, the opportunity is massive. If well executed, these digital banks could reshape Pakistan's financial ecosystem and maybe even produce the country's first banking unicorn. But the real test now is not tech or regulation, it's the staying power of the owners. For more on this story, find Nadeem Hussein's Business and Finance weekly article linked in the description.